Good day, good day. Today we will be discussing the interpretation of financial statements. Some of you know it as ratios or financial indicators, but then we are just interpreting our financial statements to make decisions. That hence it is called like interpretation. We interpret our financial statement so that our owners, our stakeholders, our users of our financial statements can make better decisions. Okay, let's start with the topic. So here we're just doing a past paper. We have Dodo Ltd and Nasha Ltd. You are provided with the information relating to two companies. Ben Komani holds shares in both the companies. So required, where they say you must read the required to ensure that you answer the question. Where comments or explanations are required, you should quote financial indicators and trends with figures, meaning you mention the ratio and you give the proof you support with figures. Give a reason or an explanation for the financial indicator quoted. Okay, so 3.1, we're talking about profitability. So profitability indicators, like if you want to get it correct in an exam or test or whatever, you have to know what relates to the profitability ratio. You can't mention like loans. You can't mention loans, maybe return on shareholders equity when they tell you about profitability ratios. So you must link it to the profit ratio. So if you go to the information, you have like markup percentage, you have the markup percentage, you have the operating expenses on sales, you have the net profit after tax on sales. So it has profit in it. So operating expenses also impact our profit, because we know expenses reduce our profit. So it relates to the profitability ratios. Even the markup also impact our profitability. So I think we have three ratios relating to our profitability. You can't mention like solvency. No, you have to stick to the things that impact your profitability, your profit. So I hope you get it. So let's they said they want code to financial indicators with figures and trends of the company that showed an improvement in their operating efficiency. So when doing this topic, um you have to like to underline the keywords. Like for example, showed an improvement, which means you have to talk about the good things only, the improvements only. You can't talk about the bad things, because they said improvement, which means you look for things that went up, things that increased, improved, things that are doing better. I hope you get the logic. So I think that that is what will make you like ace this chapter, always get total when it comes to this chapter. So you have to understand the difference between improvement, good or bad, whatever. We'll discuss everything in detail later. Okay, we want an improvement. So let's come to our net profit after tax on sales. Net profit after tax on sales. So this is our profitability ratio. They said which company? I don't, let me code to financial with trend that. Oh, code to financial indicators with figures and trends of the company that shows an improvement in their operating efficiency. Oh, okay, we are comparing the two companies and we want the profitability that shows an improvement. So if you come to Dodo Ltd, their net profit after tax for 2022 was sitting on 10.2%, but they say decreased to 9.4%. This is not an improvement. This is not an improvement. We want an improvement. So if we come here, Nasha Ltd, their net profit after tax increased from 3.1 to 3.8. This is an improvement. Okay, let's come to the operating expenses. We can see also their expenses increased from 3.4 to 25.2, which is not a good thing, but we are looking for good things, improvements. This one, their expenses decreased from 22% to 18%, which is a good thing. So obviously, if expenses decrease, it's a good thing because your profit will increase due to lower expenses, lower percentage of expenses. So I think Nasha Ltd, Nasha Ltd has an improvement in profitability, in profit. So they said code figures. Why? First is their, let me say, like operating expenses decreased by from 24%, decreased by 4%. Their expenses, so 22 to 18%. So it's an improvement. So their operating expenses, so I'm underlining the profitability ratios. So their operating expenses decreased by 4%. Another thing is that their net profit after tax increased. Their net profit after tax increased. So their net profit after tax increased from 3.1% to 13.8, which means it increased by 0.7%, from 13.1%, sorry, to 13.8%. So their net profit after tax increased by 0.7%. So I think it's 0.07%. Let me just verify. 13.1 minus 13.8. Yeah, it's 0.7%. So that's a good thing compared to this one. This one is not an improvement. I think, yeah, their things decreased whereas expenses increased. So note that, like, a decrease in expenses is a good thing. A decrease in percentage of expenses is a good thing. So I think we're done with this question. So looking at their liquidity, we have like 6 financial indicators for liquidity. 6 financial indicators for liquidity. So let's check them without having to read the question. Solvency, we have 1. Solvency is liquidity. And the other thing, like if you want to improve your marks, just like know your ratios, like what is liquidity. When they mention liquidity, you must know that they are talking about the solvency, the current ratio, the acid test ratio, the stock turnover rate. Like there are 6. You have to know all the liquidities just to make sure that you get total. So we have, in this case, we have 1, we have 2, we have 3, we have 4 liquidity ratios. Okay, they didn't mention all of them, but then we have creditors payment, the period it takes to pay our creditors, and we have debtors collection period. I think, yeah, that's all for our liquidity ratios. So let's go to the question. It says, the directors of Dodo Ltd are concerned about the stock control Code 1 financial indicator and other relevant financial data to support this concern. Okay, we want like we want a liquidity ratio that aligns with the stock control. Code 1 financial indicator and other relevant financial data to support. Then it says identify the company that holds more stock, show calculations and explain using financial indicators. Okay, liquidity is the ability of the company to settle its short-term commitment or debts. That's liquidity. So if the company is not liquid, it will not be able to settle its short-term debts. It will not be able to pay its short-term loans. So that's the purpose of liquidity and the meaning. So we want stock. So solvency ratio for, they say Dodo, solvency is 1,6 to 1. It's not talking about stock, but this one okay, we want liquidity ratios that aligns with the control of stock. So if we look at our stock turnover rate simply means like how often do we change stock. And remember, we are doing like Dodo Ltd, stock count, whatever, no, stock turnover rate. So if you go to Dodo Ltd, last year they were changing stock 9.8 times. It means how often did they change their stock? They changed 9.8 times, but this year 8.9 times, but this year they only changing 8.2 times, meaning their stock turnover rate decreased. Like their stock turnover rate decreased but from 8.9 to 8.2 times, which is not a good thing, because if they are changing stock lower than they did last year, it means this year they are not selling more. That's why they are not changing stock. This is what makes the directors concerned. Hope you get it. So we see by our like one financial indicator which decreased from 8.9 to 8.2 times. And another thing, the question said code one financial indicator. Our financial indicator in this case is like our financial indicator is stock turnover rate. They said only one financial indicator and other supporting financial information. So remember, they are talking about stock. So we're gonna come here. We see like we have trading stock deficit, trading stock deficit, trading stock deficit. So last year we had a deficit. This thing is like an expense, maybe losses relating to our inventory, yeah. So we had losses like amounting to 12k. Now they are amounting to 25,000, which is a concern. Like, why do we have such losses, such big amounts of losses? So deficit increased from 12,470 to 25,030, which is a concern to our directors. So let's go to the question. It wants like code one and other relevant financial data. I did that, so I think we are done with this one. Then they say identify the company that holds more stock, show calculations and explain using financial indicators. So we want a company that holds more stock, and we have to support using our financial indicators. So let's first go through our information. Okay, that holds more stock, and we support using financial indicators. Okay, this one changed the stock 14, then the acid test ratio remained the same. The current ratio, this one is 1,8, 1,3. So we want the company that holds more stock. So if we look at our the current ratio of Nasha compared to the current ratio of Dodo, the current ratio formula says like current assets current current assets is to current liabilities. So this is our current ratio. This is our current ratio formula. So if you compare the current assets, here we have and we know that inside our current assets, we have our stock. We have stock. So the current ratio for Dodo Ltd is the current ratio for Dodo Ltd is 2,3 is to 1, and for Nasha Ltd is 1,9 is to 1. So I think since we have our stock, our inventory inside our current assets, this Dodo Ltd holds more stock compared to Nasha, because their current assets is current ratio is 1,9, this one is 2,3. So if you try to find the difference, you get the difference between 2,3 minus 1,9, you'll get something like 2,3 minus 1,9, something like 0,4. So it means Dodo holds stock more than Nasha by 0,4. This is a possibility because we know that our current ratio includes our inventory or our stock. And even if you compare their stock turnover rate, this one Nasha changes stock 15 times and this one only 8,2 times, so this one doesn't hold more stock. So I think Dodo Ltd holds more stock. So the answer is Dodo holds more stock. So we are done with our liquidity ratio. So now I'm going to talk about the dividends payout policy ratio. This means it means at what rate of our profits do we pay our shareholders, like the percentage amount of our profit that goes to our shareholders, percentage amount of our profit that goes to our owners, our shareholders. So this is our dividend payout policy that goes to our owners, our shareholders. So let's check the question. So let me explain this before. So if we pay a higher percentage, it means higher percentage than than 100%. It means, yes, my typing is bad, so means so I just paused the video. I wanted to type just to save the minutes. So I'm explaining the dividends payout policy. So I've explained this. So yeah, I think, yeah, I was here. If we pay a higher percentage than 100%, it means we use this year's profit and last year's profit, no future expansion plans. So if we try to please to satisfy maybe the shareholders, we're gonna pay them a higher percentage, but then I don't think all of them might be satisfied, because some of them are concerned with sustainability. They want future growth, future expansion. So if we pay a higher percentage, a higher rate than 100%, means we used last year's retained income just to please the shareholder. So if we pay a lower percentage, it means we are saving the return for the future, or could be maybe we made a loss. These are the possibilities. We made loss. So the difference between 100% and the dividends payout rate is called retained earnings. It's called retained earnings. What we pay and 100% is called retained earnings. What we retain, it is the amount of the money that we are not paying to our shareholders for future expansion. So let's come to the question. So comment notes. Explain to Ben which company has accumulated sufficient money to finance expansion in the upcoming financial year. Quote relevant figures and provide a comparison to support your answer. So for them, if you come to my notes, for them to have future expansion, they must pay a lower percentage. Before going to the question or information, you come to my notes. For them to want more future growth or expansion, future finance, they must pay a lower percentage. Okay, we're comparing the two companies. You want the company that accumulated sufficient money. It means they didn't pay a higher dividend payout policy to their owners, shareholders. So let's come here. So let's look at the dividends payout rate. So if you come to like Nasha, they had a 50% of dividends payout rate. It means they retained how much? Remember, the difference between 100% and the dividends payout rate is called the retained income. So if Nasha paid 50%, which means they retained 50% for future expansion, for future growth or expansion. They retain 50%. So Dodo Ltd, how much did they pay? They paid 97%. 97% meaning like Dodo paid 97%. Remember, the difference between 100% and the dividend payout rate is called retained earnings. So they retained 3% for future growth. Do you get it? Or expansion for future growth or expansion. So it means like this, like Dodo paid more and this one paid less, and those ones that paid less are the ones looking for future expansion. So I think, what was the question? Which has accumulated sufficient money to finance. Okay, it means Nasha has accumulated sufficient money. So Nasha accumulated sufficient money because they paid 50%, they retained 50%. Dodo Ltd has only like 3% for future expansion, which is less. So I think they didn't accumulate sufficient funds. So any other supporting information? I don't see it. Okay, thank you.